Welcome to the Galp Q3 results call. I'll briefly introduce you to the main highlights during the quarter and then pass the floor to Filipe, who will cover the financials and the updated outlook. The macro remains extremely volatile, with Q3 seeing declining oil prices, a sharp increase in Iberian gas prices, and a downturn in refinery margins impacted by concerns of weaker demand. We continue to execute on our key strategic projects and achieved robust operational performance. Strong organic free cash flow during the quarter reflected strong operational performance, and EBITDA was close to 800 million euros and operational cash flows close to 500 million euros. Our net debt continued to decrease, even accounting for the Titan acquisition and associated debt, as well as distributions to shareholders and minority partners. All in all, Q3 2022 was a solid quarter, which saw a further improvement in our financial performance. I'll now quickly run through the performance of our different divisions. In upstream, production increased due to higher uptimes, and we saw a reduction in the price discounts to Brent and an improvement in the gas realizations, reflecting the strength of our expanded energy management capability. We are on track to meet our production targets for the year. And on Bacalhau, drilling activities are to start soon, an important milestone for the development of this significant project for Galp. On exploratory activities, the results of our São Tomé and Príncipe well did not lead to a commercial discovery. However, we acquired valuable data and will now analyze what could be the next exploratory steps related with this area. We continue to target an exploration well in our high potential block in Namibia, now targeting to happen late 2023. We're excited about the startup of Coral South, and we eagerly await the first LNG cargo. The project will start to contribute to Galp in Q4 already. Coral will put Mozambique on the LNG map as a key global supplier. LNG remains a crucial part of the energy supplies now and in the future, and Mozambique will be a core growth area, supplementing the US and Qatar. This project is an amazing accomplishment, delivered on time and on budget. Our congratulations to the operator and the Galp team supporting them. Our upstream continues to grow in the short to medium term, also with exciting opportunities for future growth. In commercial, and despite some concerns on reduced demand from the current price environment, we managed to achieve a solid contribution during the quarter, with EBITDA of over 100 million euros. Meanwhile, we continue to transform and expand our businesses. We see very strong growth in our decentralized solar business with our Iberian customers. Customers that are looking to take control of their own energy supply to their homes and businesses. In e-mobility, we have more than doubled the number of charging points year on year, heading to 2,000 by year end. In convenience retail, we continue to see growth with an additional 20% on contribution margin year on year. Looking forward, we're seeing customers reduce offtake volumes in the B2B segments, but we remain on track to surpass 300 million euros EBITDA by year end. Galp's industrial performance continues to show improving operational and safety performance, with the refinery operating at first quartile availability levels. Robust refining margins are above the average historically, but in a very volatile environment. The turmoil in the gas markets, with very high prices, a large TTF to PVP spread, coupled with the hedging position taken in 2020 by Galp, and the restrictions in supply from Nigeria, has reduced the cash flow from this segment in Q3. Nigeria's sourcing restrictions could have had an impact of over 500 million euros since 2021, but our energy management team has been able to significantly reduce this impact to well less than half of this number. And now we're dealing with the latest news received from Nigeria and monitoring the NLNG force majeure implications. We send our commiserations to the people of Nigeria for the humanitarian impact being caused by the flooding. Whilst it's still uncertain what the impacts from this event could be, as we're pre-sold the volumes, we're actively finding competitive alternative sources of gas. However, we do expect 2023 gas supply and trading contributions to improve significantly. From January onwards, we have retained flexibility in our supply and demand balances and have not hedged our gas position forward. We also look forward to the start of the competitively priced supplies from Venture Global next year. Strong renewables performance in the quarter once again as we continue to grow our capacity and capabilities. Now with a solar project in Portugal of over 100 megawatts recently started up. We now have 1.3 gigawatts under operation, fully sold under merchant conditions. Our Titan portfolio is 100% consolidated from August onwards. And on a consolidated basis, over the last 12 months, the current operating portfolio would have generated 240 million euros of EBITDA, with a gross investment capital of around 1 billion euro. We're growing fast, as in Q3, our equity renewables energy generation is double that of Q3 last year. And we're getting close to the 1.4 gigawatts we forecast for year end. We're confident in being able to deliver against our growth targets of 4 gigawatts by 2025 and 12 gigawatts by 2030. In summary, we continue to make good progress towards our objectives of growth, decarbonisation, and competitive distributions. We are growing our established businesses with the start of Coral and the progress of Bacalhau, meanwhile transforming and growing our industrial and commercial businesses. We're decarbonising the energy we produce through growth in renewables. We have doubled the equity renewable electricity generation year on year, and we're advancing with renewable fuels and battery value chain projects. Our robust financial position allows us to offer competitive shareholder distributions. We're finalising the 150 million buyback programme, with shares to be cancelled by year end. And although we're slightly more conservative on our guidance for the year, we continue to remain confident that Galp may buy back as much as 500 million euro related with 2022 performance. I'm confident the journey we're on to regenerate the future together will continue delivering strong results, and that Galp has the quality of team and assets will allow us to grow and transform, leading the sector in the energy transition. It's been a privilege to be part of this journey as Galp's CEO. I'll now hand over to Filipe.
Thank you, Andy, and thanks everybody for watching. For me, the key themes of the quarter: in upstream, EBITDA was 612 million. This is driven by increased production as expected and improved oil differentials to Brent and gas realizations. At the end of Q3, we had 3 cargoes in transit, and this is higher than usual. A cargo in transit is valued at cost of production, so the EBITDA does not reflect the market price of the molecules. This gets booked only in the following quarter. In EBITDA, in upstream, we also have the Berbigão Sururu unitization. What is that? So our post-unitization stake will be lower than the current one. So EBITDA booked to date is adjusted by 138 million to what will be our entitlement post-unitization. And at completion of the unitization, we will be compensated for the capex we have invested over and above our final share. So the net cash effect between the two is calculated at the end of September is a Galp payable of about 40 million. We have always assumed this effect to occur this year. So this was baked into our guidance. Commercial was solid with 103 million in EBITDA. This was supported by recovery in oil volumes, mostly aviation and marine bunkers. B2B gas and electricity sales, however, are starting to be impacted by slowdown in activity. In refining and energy management, EBITDA was 48 million. And here we saw strong operational performance in refining with good throughput in the refinery. And our refining margin now values the input cost of the natural gas to the refinery at the Iberian spot prices. Our refining hedges had an impact of 70 million, with a wide basis differential between the refining indicator we had hedged and the actual realized one. And we continue to face sourcing restrictions, and we have been impacted by gas pricing differentials. So because of our hedges, TTF is our effective acquisition cost of gas. We had to place some of the gas in Iberia at PVB pricing, which is trading at a significant discount to TTF, given the TTF issues that we're facing. On renewables and new business, we now have our renewable assets fully consolidated with the acquisition of the remaining stake in Titan back in July. So from August onwards, EBITDA was 38 million. It would have been over 60 million if the entire quarter had been consolidated. Overall, group EBITDA was 784 million. That's up 29% from last year. Below the line, we have booked a 34 million impairment related to the exploration well we have drilled this year in São Tomé and Príncipe. We also recognized in RCA numbers 88 million related with 2022 provisions for the decommissioning of the Matosinhos refinery and its transformation into a new site. Now, this was booked under special items previously. Financial results were positive, reflecting the mark-to-market gains from the Brent and refining hedges, while the implicit tax rate was higher than usual given the fiscal treatment of in-transit cargoes and the unitization impact. All in all, group net income was 187 million. Now, if I move to cash flows, OCF of 484 million considers the unitization adjustments. CFFO was 1 billion, as the decrease in commodities and the roll-off of our gas derivative positions drove a working capital release of almost 700 million. Net capex this quarter was 558 million, including 140 for the Titan solar acquisition. Renewable development costs are now showing at 100%, and we also had the higher investment for the commissioning and startup of Coral Sul in Mozambique. Free cash flow generation was 427 million, and we reduced net debt by 89 million in the quarter after dividends and buybacks of around 280 million, and the consolidation of Titan's net debt. So overall, this leads to a net debt to EBITDA of about 0.6 times. We are keeping most macro assumptions unchanged for the rest of the year, except for the stronger dollar against the euro. So we are adjusting downwards industrials and energy management, where we now expect EBITDA to be around 500 million in 2022. Now, this assumes the higher than expected impact from gas sourcing restrictions in Q3, as well as a more conservative case for Q4, given the still wide PVB TTF gas pricing differentials. We are not factoring in the latest Nigeria LNG notice of force majeure. If we look at the current month-ahead Iberian gas prices of about 70 euros per megawatt hour, a missed cargo could represent a hit to EBITDA of 40 to 50 million. The expected OCF of 2.8 billion for the full year keeps expected distributions of around 900 million euros, with a buyback of about 500 million related with 2022. And this is in line with what we said back in July. We update our net capex estimates to 1.1 to 1.2 billion, this to accommodate for the stronger dollar, but also considering some renewable capex now at 100%. On the other hand, we are benefiting from the dollar appreciation on our dollar cash positions when translated to euros. As we conclude, I would like to thank Andy for all he has brought to Galp over the last couple of years, and I wish him all the best for the future. Thank you.